below street expectations, with the company forecasting $194 to $196 million versus estimates of around $241.7 million. Joining us now in a closing bell exclusive interview is Chegg Chairman and CEO Daniel Rosensweig. First of all, thanks for coming on. And in good times and bad, tough day for you, Dan. Just explain why everyone was so caught off guard by what's happening in the business right now.
Yeah, a couple of things. First of all, I think you can tell from the reaction of the stock that it's significantly overblown. It's sort of absolutely surprising. Not that it went down, but that just at the level and the volume, because we feel very confident about the future of the company, where we're going, the opportunity, the international growth. But what caught us off guard, and therefore everybody else, was the fact that much like young people going back to the office, they just don't want to go. College enrollment is substantially down. It's been down 3 years in a row. Normally during a recession, it goes up, which was last year, but because of COVID, it didn't. So it went down. International students didn't come. This year, because the economy is so strong, that ambitious students, like the ones that use Chegg, they chose not to go back to school. They chose to go work because the salaries are so high. They also have children, so we have child care issues because 60-some-odd% of all college students are women. The average age is actually 25 years old. So we serve a lot of people that are balancing family, workplace, and school at the same time. And community colleges just literally, feel like they're empty in terms of people making different choices this semester. Add fatigue to that, which is even those students that chose to go back are taking nearly 10% fewer classes per student. 16% of students are taking more pass-fail than they have in the past. And it was just a whole bunch of things that we didn't anticipate, because we were doing phenomenally well the whole year, July, August, even the beginning of September. Somewhere around mid-September, when it normally picks up, it just didn't. And so enrollment and fatigue and people taking jobs where they can get paid a lot more money than they historically have been paid, and along with the fact that we can see from the usage of Chegg that professors are assigning less right now, maybe they have fatigue. So it's not sustainable. And the good news on the core business is outside of North America, international growth is great. Inside North America, conversions up, renewals are up, cancels are down, ARPU is up 5%. So the core aspects of the business are fine. We just need a bigger top of the funnel right now as we build out some of our newer growth areas.
I think one of the problems, and all the analysts are downgrading the stock and all the investors are selling today, is the lack of visibility into when it will return. Are you expecting that you're going to have to wait till next fall? Does enrollment usually go up during spring quarters? What are you telling investors today about when some of these trends might turn around, or just do you have no idea?
Well, truth is we can't know. We didn't know this, and we only really learned this about 30 days ago. And of course, we were in the quiet period, so we had to communicate it now. We actually had a really good Q3 overall, so you can see from our business that it was going great. Here's what we expect. So the school year is different than the calendar year. The school year starts in September and goes through May. So this is the big start of the school year. It's obviously much smaller than we and all colleges expected. And I think you can see it from every piece of data. If you look at free sites, paid sites, every one of them is significantly down. We're actually down less. So we're likely gaining market share because leading companies do that. So the weird part of this is normally you'd expect, okay, it'll be next August or September. But because so many students are community college students and online students and go to 4-year schools where they're really not trying to get a degree, they're just taking some courses, those could come back earlier. We just don't know. So the logical thing as a company that has always beat and raised was to not put ourselves in a situation where we could be wrong again. And so we're going to wait until February to give guidance. Most companies didn't give guidance at all during the pandemic. We gave guidance for the whole year. So we're now getting our pandemic hit now versus when everybody else got there. So we just want to be prudent and smart. But the long-term proposition of the business remains the same. We see a lot of the vectors doing really, really well. It just was a surprise, and we're doing the best we can in this moment.
So I know no formal guidance, but are you confident that there'll definitely be top-line growth, or not even of confidence of that?
Well, what I can say, Wilfred, without getting myself in too much trouble, is the fact that we are seeing subscriber growth outside of North America that is excellent. We are seeing ARPU growth and revenue improvements in the U.S. because a larger number of our students are taking the 1995 versus the 1495. We see our renewals up. We imagine for the long term, Wilfred, to continue to be a growth company. We see revenue increases, profit increases. We're probably the only ed tech company that is EBITDA positive, cash flow positive. We're in great shape to handle this moment in time, and this moment in time has to pass and will pass. And we'll just keep executing and investing during this period of time to capture the future growth in the U.S. But outside the U.S., we're already continue to see excellent growth, both in revenue and subscribers.
So long term, I totally get that. But next calendar year could possibly be a revenue decline?
Look, anything could happen. I think that's what we learned here. That seems highly unlikely to me, given the success that we're having outside of North America and given the ARPU increases that we're seeing and the take rate increases that we're seeing at Chegg Study Pack. But, if we've learned anything, we don't really know what's going to happen with the college market. I anticipate that this is short-lived because it's unsustainable. The economy's not going to be this way. People are not going to be getting paid that kind of money for those jobs after the supply chain issues and after the holidays. So I would imagine things will get back to normal in 22 sooner than we think, but it's too soon to predict.
So can you just clarify, Dan, is this an industry-wide problem? Is there anything Chegg specific here?
The only thing Chegg specific is that we're doing better against renewals and take rate and all the good stuff. This is absolutely 100% industry specific. You can look at any of the traffic to free sites, to paid sites, they are all significantly down. You can look at all the college enrollment numbers, they are all significantly down. You can look at the reporting of companies like Pearson and the bookstores. Everybody's acknowledging that enrollment is down way more than they expected. So it feels a lot, Sarah, like people who don't want to go back to the office didn't want to go back to school either. And it's a moment in time, it's not sustainable, and it's unfortunate for us at this moment, but we feel very good and very confident about the long-term business. But this is 100% industry-wide. We checked every one of our numbers. I know everybody in the industry. I called everybody. We've looked at a lot of companies during this period. Somewhere around mid-September, towards the end of September, it just became clear that enrollment wasn't going to pick up.
What do you say? We're looking at actually enrollments, and as you noted, Dan, they've been declining for years now. It's not just this year, and in fact, they're looking better than last year, which was during the pandemic. What do you say to those, though, that are wondering, given this trend, maybe Chegg is near a saturation point for the U.S., and maybe that came a little bit sooner than people were expecting. If we continue to see enrollment falling year after year.
Yeah, look, we still have, we're only about 25% penetrated, so we still have more penetration to go. The second thing is a lot of these people will come back because these are more adult learners. So the demographics of the younger learner, I agree with you, but the adult learners are coming back into the market. They just have an opportunity to make so much money right now that the Chegg customer is the ambitious customer that actually wants to work right now because they can make more money and not take on debt. But in addition to that, there's so many vectors for growth for Chegg, both domestically and obviously international is growing. But domestically, there are a whole lot of student problems that Chegg can continue to solve that we have yet to bring out. We've increased our personalization, which increases discovery and engagement, which means there'll be many more services that we'll be bringing through. So with the homework help specifically, there's still years to come of growth. But in addition to that, there's so much more to do. And then on the revenue growth side, we are actually seeing ARPU growth because we are having students take the more expensive version of the product. And so there'll be revenue growth and profit growth and cash flow growth. So we still think there's plenty of growth domestically and substantial growth internationally, where we imagine one day international being bigger than domestic because it's just more people.
Dan Rosenzweig, thank you for coming on. We appreciate the time, especially on a day like today.
We appreciate you giving us the opportunity.